Hi guys, welcome to Apex Academics in this fantastic free MCQ coaching series where we are going to post four big MCQs for you on a daily basis. Monday, Wednesday, Friday are the days allocated for part 2 US CMA MCQs and Tuesday, Thursday, Saturday for part 1 MCQs. Today is part 2 US CMA MCQs and the MCQs are on the screen. For this, drop a message on the number that you can see on the screen right now. On this number, if you drop a message, we will add you to our WhatsApp group. On that WhatsApp group, you will get these messages of questions in the form of a poll and you can get many more updates. Also, if you subscribe to Apex Academics, you will get a lot of updates for CA, ACCA, US CMA, CPA, CFA, and FRM on a daily basis. So, with the intention of making sure MCQ practice is done in abundance, let us begin our first MCQ of the series. Liverpool Corporation has decided to include certain financial ratios in its year-end annual report to its shareholders. Selected information relating to the most recent fiscal year is provided below. You have cash of 10,000, account receivable at the end of the year 20, account receivable at the beginning of the year 24. Always remember, when you have accounts receivable data for beginning and at the end of the year, it shows clearly that the institute wants you to calculate average accounts receivable. Same way, inventory is given beginning and end, so they may want you to calculate average inventory as well. Next, they are telling us notes payable are due in 90 days. So since they are due within 365 days of the balance sheet date, they become your current liabilities, and bonds are payable within 10 years. So they become our long-term liabilities, non-current liabilities, because they are due in a period beyond 365 days of the date of the balance sheet. Next, our net credit sales for the year are 2,20,000 and COGS cost of goods sold is 1,40,000. Using a 365-day year, Liverpool's days outstanding in receivables are calculated as what? All right. Now, days outstanding in receivable is obviously connected to your accounts receivable. There is one way of doing this, that is the long cut formula. That is your long cut. What do we do in the long cut? In long cut, step number one, we will calculate accounts receivable turnover ratio, which is nothing but credit sales divided by average accounts receivable, which is 2,20,000 divided by average is 20 plus 24 divided by 2 divided by 2. So this comes to 2,20,000 divided by 22,000. This comes to 10 times. Now, days sales in accounts receivable or days outstanding, days sales in accounts receivable is given as 365 divided by accounts receivable turnover, which is 365 divided by 10, which is 36.5 days, which is how much? 36.5 days. Now, first of all, for your mental satisfaction, let us present the option 36.5 in front of you. So you can see that 36.5 is your answer. But my dear students, there is a shorter and a faster way of calculating this. Here, I request all the students watching the video to copy this down, pause the video, and please copy this down. Do not look at this video, watch this video like it's a reel. Don't treat it like some news update or some beer biceps podcast. Make sure that you are watching this like a coaching class. Pause the video, copy this down, because now I'm going to give you the shortcut formula. What is the shortcut formula? Shortcut formula is very simple. What do you do in the shortcut formula? You are going to say average accounts receivable upon credit sales divided by 365. So what are your average accounts receivable? They will be 20,000 plus 24,000 upon 2,20,000 divided by 365. Why 365? Because we're using a 365-day year. So this will be, and of course, this is divided by 2 because it is average. So it is 22,000 divided by, so 2,20,000 divided by 365. The number that you will get is 602, is 602.6 73977726027 on your regular calculators. So now this will be 22,000 divided by that large number. Your answer comes to 36.5 days. So the accounts receivable on the day of the balance sheet, it is at the end of the year, signify 36.5 days of sale. All the concepts relating to these questions are discussed in a regular conceptual batch which are open for admissions. Please reach out to Apex Academics on the said number and we will ensure that you are a part of our batches. These are MCQ exercise videos, so focus on them for the purposes of your MCQ learnings. All right, pause the video, copy the solution down. Let's go to the next question. The next question, again an interesting question. What are they asking us in this particular question? They are saying that Clark has prepared the following financial information for its initial public offering. It has a long-term debt of 1 crore, that is 10 million. Par value of equity shares is 3 million, that is 30 lakhs. So 30 lakhs worth of equity shares total, and the value of one equity share is $1. That gives us 30 lakhs or 3 million outstanding equity shares. 3 million outstanding equity shares. Important concept. Additional paid in capital is nothing but securities premium as per Indian terms. Retained earnings are your general reserve, P&L, etc. Total assets are given, net income is given, which is quite important number, because my dear friends, net income is nothing but net profit after tax. What is net income? It is nothing but net profit after tax, and that is 37 lakh 50,000, which is 3.75 million. Now they are saying that the annual dividend is 1.5 million, 15 lakhs. I want you to note that this is purely an equity dividend. This is not a preference dividend, because anywhere in the capital structure, we don't have the preference shares. If the public companies in this industry are trading at 12 times earnings, means the price earning ratio or the price earning multiple is 12 times. What is the estimated value per share of Clark? My dear friends, net profit after tax minus preference dividend, which is nil, gives us earnings available for equity shareholders, which are 37 lakh and 50,000, divided by the number of equity shares, which are 30 lakhs, we arrive upon 1.25 as your EPS. Let's just take 37.5. 37.5 divided by 30. Yes, it's 1.25 is your EPS. My dear friends, price earning multiple is market price per share upon earning per share. Therefore, if I was to say that, 12 is equal to market price per share upon EPS, and my EPS over here in this question has been clearly given to me as 1.25. Given se zyada, I have calculated it. What is my MPS? My MPS is 12 multiplied by 1.25, which should be 15. The answer here should be 15 per share. Now here, my dear friends, there is a common mistake that students make. Let us highlight that common mistake very much importantly. So what is the common mistake? Please pay attention to the common mistake. You're under stress, you're in the exams. So what happens is, you don't realize that this dividend is equity dividend. You will take this as NPAT. You will write 37 lakh 50,000, which is okay. But then you will subtract from this the dividend, thinking that this is what dividend? This is preference dividend, whereas there are no preference shares in the company. This comes to 22 lakh and 50,000, as you will call this now earnings available for equity shareholders, whereas this is not earnings available for equity shareholders. This is nothing but your retained earnings. These are your retained earnings of the company. Please keep that much in mind. Now this you will divide by the number of shares, which are 30 lakhs, coming to 0.75, and then you will multiply this by the PE ratio of 12 times, and 9 will become your market price per share, which is absolutely wrong. This has been given to confuse you, and they want you to make this mistake so that they can take your marks away. 15 here is the absolutely correct answer. So ensure that when you are solving, you have also copied down the common mistake part of this, because that is a must for you to notice and have. Please pause the video and copy this part down. Thanks. I hope you are all with me on the explanation. Let's go to question number 3 of Edward Products. Now, what has Edward Products done? Edward Products has now recently developed a new product that has a manufacturing cost of $30. The marketing director has identified 3 marketing approaches for this product. The first marketing approach, we'll write that down in red ink, is having a selling price of 36 and of course a manufacturing cost of 30 per unit, which is going to be nothing but a variable cost. So my dear friends, sales minus variable cost is equal to contribution. We have to keep that much in mind. And the firm sales staff sell the product at a 10% commission, which is again a variable cost. But of course, this is a variable selling cost. What is this? This is a variable selling cost. So keep that much in mind. So if I have to arrive upon contribution, it has to be sales minus all the variable cost. So sales is 36 minus variable cost of production minus the 10% of commission, which is obviously paid on selling price. My dear friends, this will be multiplied by the total number of units, because I can't see any fixed costs given here. So this I multiply by the total number of units, and my net profit for this is going to be how much? 36 minus 30 minus 3.6, which is 2.4 multiplied by 10,000. It will give me how much? It will give me $24,000 as my net profit. This question wants me to rank the 3 alternatives from the net profit, highest net profit to the lowest net profit. Now I have to calculate in the same fashion net profit of all others. Now for this particular approach, why let's use black ink. Selling price is 38, cost of production stays at 30. So first I will do 38 minus 30 over here. Then I will see that they have a 10% commission. So 10% multiply by 38. This is my variable cost. All variable costs removed from selling price, I have arrived upon contribution per unit. For how many units? For 12,000 units. This is my total contribution. And from this total contribution, I will subtract any fixed cost. And they are telling that to back up this, we need a $30,000 advertisement program. So I'll say minus $30,000 over here. So this is going to be 38 minus 30 minus 3.8. So per unit contribution comes to 4.2 for 12,000 units, making my total contribution 50,400. Please do it on your calculators while you are watching this. And from this subtract 30,000. What I will get is 20,400 as my net profit for this particular alternative. Let's go to the last alternative. The last alternative, please let us do it in the blue color. Now, what are they saying? They are saying that we will rely on the wholesaler to handle the product. Edwards will sell the product at 32, incur no selling expenses. There will be 14,000 units. Na rahegi baas, na bachegi basri, that kind of a thing. Selling price, seedha 32. From that 30 manufacturing cost, you are out. 2 per unit is your profit. 14,000 units, 28,000 is going to be your profit. So obviously, your first rank goes to Z, your second rank goes to X, and your last rank goes to Y. So your answer has to be Z, X, Y. We are looking for alternative Z, X, Y. We are looking for Z, X, Y. And here we find the alternative Z, X, Y as our answer. Please make sure that you have paused the video. Please make sure that you have paused the video and have copied down all these workings that are essential to have a complete solution for your practice. Next, let's go to the next question, which is an interesting question on multiple product break-even points which use weighted contribution. Let's take a look at what this question is asking us now. Now look at what this question says. This question is saying to us that Ace Manufacturing plans to produce the 2 products, product C and product F. Okay, let's write here product C and product F. Now, what are they saying? During the next year, the selling price of C is 10 with a variable cost of 8, therefore giving me a contribution of 2 per unit. It has got the units sold. How many? 20,000. All right. F has got a selling price of 15, a variable cost of 10, a contribution of 5, and units sold are 5,000. Total projected fixed costs are 30,000. Assume that the product mix would be the same at the break-even point as at the expected level of sales, meaning that this product mix of 20 is to 5, that is 4 is to 1, that is nothing but 4 upon 5 and 1 upon 5, which is nothing but 80%, and 20% is continuing throughout. What is the projected number of rounded off units? This is important. Rounded off units of product C to be sold at the break even point. My dear friends, we have got common fixed costs. What are these? These are common fixed costs and not the individual fixed costs. For common fixed cost, we will arrive upon a common break even point by using weighted average contribution, wherein this weight we will multiply by the individual contributions to arrive upon your weighted average contribution. So 0.8 is the weight multiplied by 2 gives you 1.6, and 0.2 is the weight multiplied by 5, that is 1 gives you 1. So your weighted contribution comes to 2.6 per unit on a total fixed cost. So your combined break-even point for both the products on a combined total fixed cost of 30,000 divided by the weighted contribution. Now here let us go into formulas quickly. See my dear students, break-even point is equal to your total fixed cost divided by contribution per unit or PV ratio. But here when I say total fixed cost, it is the entire entity's fixed cost. Now this entity, if it is making 2 units or 3 units or 4 units or 5, this contribution will become weighted contribution. It will become weighted contribution for multiple products. For what? For multiple products, it will be a weighted contribution, and this is going to be for a single product. In our question, we have got multiple product. Therefore, we will have to take a weighted one. So this will be 30,000 divided by 2.6. Our answer comes to a combined break-even point of 11,538.46. Out of this, C has got 80% for it. So multiply this by 0.8. Your answer will be 9230.769, which is approximately rounded off to 9231 for C. And let's calculate for F also, which will be 20%. So we are looking at 11,538.46 multiplied by 20%. Our answer comes to 2307.692, which will now be rounded off to 2308 units for F. Now let us look at the alternatives. They are giving us the alternatives. They are asking us C, be careful. So 2308 units is for F, can't be the answer. This is obviously for C. This is your answer. 11,538 is the combined break-even point. Again, this cannot be your answer. And 15,000 units is just some hogwash rubbish given to confuse you. With this, the big 4 MCQs of the day have been solved. Please rewind the video, watch all the workings. Make sure that this is sent to as many students as possible for US CMA. We are focusing on US CMA MCQs for your passing and for your betterment. So make sure that this is shared to as many US CMA students as possible, irrespective of whether you have taken your coaching or not taken your coaching. Our batches for US CMA with special focus on MCQs from multiple study materials are open. Kindly contact us on this number that you can see on the screen, and make sure that you pass your US CMA with us, because we will make sure when you join, your success and your passing is our commitment at Apex Academics. Best of luck. And if you can find out why Lawrence Bishnoi is so angry with Salman Khan, please tell us so that we would also have the current gossip, because we are so busy with US CMA, we don't know what is happening in the world of Bollywood. We want to know why Lawrence is so angry with Salman, so that we can, pray for Salman that nothing bad happens to him. So best of luck and keep following us for more on US CMA.